Good morning, good afternoon, everybody. I'm Frederick Bromroot from EDHEC Infra, and I'm here with Abhishek Gupta and Natalia Gedarenko to tell you today about fair value in infrastructure investments. And in particular, how you can use Inframetrics, which is our data platform, to better assess fair value for infrastructure investments. So I'm going to start with today with a short discussion on what's fair value. I'm going to have to go through that particular topic first and how you might measure it. And then I'm going to leave it to Abhishek to show you how it's actually done using Inframetrics. And then in different moments, Natalia will intervene and give you a little polls to answer. So we'll see what your views might be on different aspects of fair value. Right. Just as a quick introduction to who we are, I think this may be familiar to some of you, but it's only one slide. EDHEC Infra is an index provider. We're now a regulated index provider. And we release every month new data for the Infra 300 index and the Infra 100 families of indices, and actually a whole bunch of other indices as well, which are used by investors for indexing purposes. We also provide investment analytics around the valuation and the performance of infrastructure companies, and this is a lot what we're going to talk about today, and what are the discount rates, what's the correct yield curve, and which cash flow forecast to use, etc., etc. And in this context, we also provide customized solutions. So for a number of our clients, we make benchmarks specifically for specific products or specific strategies. Today, that's data that's being used by quite a lot of people, representing $400 billion of infrastructure assets under management, and that's growing. So our agenda today. First, I think it's essential to talk about why fair value matters. And here, it's easy to get lost in some kind of philosophical discussion about fair value, so I'd like to avoid that. Instead, I'd like to go through a few points about what fair value is in the rules, in the regulation, and therefore what it's meant to be in terms of reporting, and also why. Because in the end, that's in large part why we need to compute fair value on an ongoing basis. And then I'll go through our methodology and try and make it as fun and didactic as possible, but show you that in a private market with infrequent transactions, illiquid assets, you can still measure fair value on an ongoing basis and come up with something that's pretty convincing, and also that's very usable in an investment context. Right? And then Abhishek will show you how to do it using Inframetrics, and come back at the end to talk about what's happening now with the regulation of fair value in investment management, and in particular for infrastructure, because this is private assets, maybe more generally, because that's a moving topic, very much so. We were on a call yesterday morning, again, very early, with Australian regulators, for instance, and that keeps evolving. Right, but let's start with a little question. So I'll ask Natalia to start our first poll for the audience, which is the following. Infrastructure funds that comply with the IFRS valuation principles mark their assets on a held-to-maturity basis. What do you think? Always, most of the time, rarely, or never? Now, if you look at the picture on the right, you can guess that this is a trick question, and I'll give you the answer in a minute. So let's see. Okay, we have a whole lot of answers. Not everybody, though. Please try and chip in. We need a big sample so we have a statistically significant result. Okay. We're getting close to having a big sample. Quite a big sample, actually. Come on, a few more. Okay, so I think we can share the results now, please. Okay, so this is what people said. Hopefully you can see that. Interesting. So I guess the majority thinks that the assets are held to maturity most of the time or always. And then there's another group that would say rarely or never. So we'll come back to this, but keep that in mind, right? All right, so fair value. I cannot start without showing you the definition of fair value. Of course, you all know what that is. Fair value, it means the price, the exit price in an orderly market between willing buyers and sellers. That's not a new thing. But again, I want to set this very clearly because this isn't a philosophical debate. This is about what the rules say. So you have to have an exit price in a market, and it has to be on a specific date. In other words, and we'll come back to this repeatedly, it has to be using the latest market data, the latest market information. Okay, that's fair value, according to IFRS 13. And this fair value, this notion of fair value and the definition of fair value is actually found everywhere in the regulation. Of course, it applies to practically every asset manager, insurer, or pension plan. It's in the IPEV guidelines, which are designed to reflect fair value. And as a point of, this is sometimes a point of contention, so I just want to highlight this here. There's only one type of fair value. It's the fair value or the fair market value. It's the same thing. There's no argument about whether these are two different things. If you follow the rules, there's only one fair value, okay? And it's the same thing as the fair market value. It's the exit price on a given date between buyers and sellers in an orderly market, okay? So one thing that's interesting is that this has changed, this has evolved. So there used to be exceptions to this definition, and particularly for non-traded equities, but these have all been removed from IFRS. And since 2014, and also the IFRS 9 standard, the application of amortized costs and accounting has practically disappeared. It only applies to certain types of loans and receivables, okay? And in fact, even that, so even for debt, if you look at IPEV, so that what applies to the guidelines, at least for private funds, even debt should be treated on a fair value basis. Okay, so only one fair value, and it's basically everywhere in your reporting requirements. What that means is that there's no such thing as a long-term fair value. That doesn't make sense. There's no space in the regulation to say, oh, the fair value, it's our exit value later in the long term, no. There's no room for a conservative approach by which you would say, well, we'll keep the net asset value, conservatively, because we'll see later what it is. It should be, as much as we can tell, what the latest market price is. And while this is of course, it's practice of not changing the value too much, so smoothing it basically is sometimes presented as a way of protecting LPs against risk. It's actually in direct contradiction with IFRS. And this is something that is increasingly being looked into by regulators. We'll come back to this, but I think this eventually creates legal risks for a number of managers. And so let's go back to holding to maturity. So a number of you were saying, well, no, holding to maturity is the way you do infrastructure asset sort of accounting. And it's true that there's often a reference when you talk about infrastructure investment to hold long-term investing and holding things to maturity. But again, if you follow the rules, there can only be one fair value. And it's the fair value on a given date. Of course, there's a range, there's a bid-ask spread. It's not a perfect one price because it's an illiquid market, it's a segmented market. You can't short, etc. So it's not like the stock market, right? But there is no different versions of fair value that would depend on whether you're holding the asset for the next 2 years or for the next 10 years or for the next 20 years. Or whether you're holding the asset via a fund or directly or via co-investment. None of these things define what fair value is, and therefore you cannot change fair value or determine fair value on that basis. So holding to maturity is not a thing. In fact, it's not a thing at all in IFRS. It's disappeared. It's been removed from IFRS. And so it might be a shorthand for a lot of a reference to investment strategy, to a style of investment, etc. But when it comes to fair value, you can say, oh, I'm holding to maturity, so I don't care about fair value, or I don't care about the level of interest rates, or I don't care about the market, etc. Because as far as the rules are concerned, there's only one fair value, and it doesn't have anything to do with whether you're holding to maturity or not. On top of that, there are other disclosures like IFRS 7, so, risk disclosures in particular, which require a sensitivity analysis, which is relevant, which relates to a specific market, the market for this asset. And again, this can only be an expression of fair value. Otherwise, you can't do a sensitivity analysis. So you, in fact, always have to have fair value in mind. And finally, when it comes to how it's measured, of course, with infrastructure and more generally liquid unlisted assets, we have to rely on so-called level 3 data, so unobservable and no market prices. There's not a market clearing price observable all the time. But what the rule says that fair value should be estimated as if there was a market. So you have to use a proxy or a model. But that remains the fact. The fact that you have to rely on level 3 data doesn't mean that you can pick any data you want. The model should use the latest observable market data, right? So that's the lay of the land, if you want, in terms of what fair value is and how it's defined in the rules. So as you can see, when you talk about holding to maturity, of course, it depends exactly what you're saying, but I think our question was fairly clear, which is what, how are you marking your assets? And the idea that you're holding your assets on a hold to maturity basis is actually nowhere in the rules. In other words, you cannot do this. And you're not doing this, in fact, because your accountants won't let you. So let's have another question. Natalia, please, if you could launch this particular one. Our infrastructure funds Q4 2022 NAVs, which I think you have now seen, based on higher discount rates reflecting the level of interest rates at that time, and by which we mean at the end of the year, at the end of last year. So presumably higher interest rates than we had previously. Okay, so we have an interesting set of responses. Please give us a few more. Okay, that's very good. Large sample already. Okay, Natalia, could you please share those results? Okay. So 1/4 of you, almost 30%, think that they're fully reflected. Okay, which is that's what they should be. So that's good. Partially reflected, not too surprising, because these things tend to be adjusted slowly. But again, should they be? And only 15% of you think that they're not reflected at all. So this is what you might expect, right? That there's of course been some evolution of discount rates, which means that NAVs should have decreased, at least to some extent, but not fully reflected in most cases. Okay, so the reason why it's like this is because this is difficult to do. So here I'm not trying to say that this is not done properly or whatever, even though some of the practices could be called into question. I'll get to this in a second. But the key thing is that this is hard to do. And this is where we try to add value and with our work. And so now let me go into a little bit how we measure fair value with Inframetrics. So to go back to basics, when you measure the NAVs, the net asset value of an asset, the price of an asset, you're effectively looking at the next dividend and the next value, right? So this is probably the most basic equation in sort of asset valuation. And for this, you need a discount rate between two periods, right? So you discount between one and now and the next period. the dividend and the net asset value at the end of the next period, if you know what that is. But with infrastructure, of course, we mostly use DCF. That's because of the nature of infrastructure assets. Terminal values which are always an issue, are not necessary. We can look at all the cash flows of the assets and value them on that basis. So we can do a nice DCF. So it looks like that. You have your dividends over time and you discount them with not one discount rate, but a number of discount factors, right? Because at each point in time, you need a different number to discount. It's basically the way you would do for a bond. Of course, some would use one number, but this one number, which counts for all maturities of the cash flows, should then be some kind of summary of all these different maturities of discount rates. Normally, you have a term structure, so a different discount factor for each cash flow in the future. And this term structure is a yield curve. It's made with the yield curve, so it's the risk-free rate in a specific country, of course, where the asset is at a specific point in time. This is until the maturity of the asset, and a risk premium, which reflects the fact that those cash flows are not risk-free. So you add a risk premium to reflect the market price of risk of those future dividends. Okay, so far so good. This is the most basic sort of valuation approach you can think of. And let me reassure you that these are, I think, the only equations. No, it's not completely true, but almost all the equations you'll see today. The point here is that in order to do this and comply with IFRS, you need to have the latest dividend value, the latest yield curve, and the latest yield premium, risk premium, right? Again, easy to say, maybe not so easy to do, but that's what you should aim for. Now, a while ago, maybe a couple of months ago, my colleagues, Abhishek and another colleague, Tim Whitaker, went to talk to a whole bunch of valuers about how they do things for infrastructure. And we found out a few interesting stylized facts after about 20 interviews. First, we found that the fund target IRR is often used as the discount rate to compute the net asset value of the assets of the fund. So clearly this doesn't reflect what I just described, which is that the discount rate should be a reflection of the latest yield curve and the latest risk premium in the market. It would help, of course, having a fund that tends to converge towards its target IRR, but you can't really say it's mark to market. Therefore, you can't really say it's fair value. Most of the inputs that people describe when they come up with a discount rate either come from listed equity, which might make you wonder about how comparable this is with unlisted infrastructure, or they come from a proprietary database of transactions that is a bit of a black box. Some firms still use CAPM, not to name them, but they tend to be the large accounting firms because that's the standard, I guess. But that means they use an equity risk premium that comes from the listed market because that's where they take it from. It also means that it's a bit problematic because, as I like to remind our students, we are one of the few things we know for sure in finance is that CAPM doesn't work. And then the change of valuation methodologies tend to change with the client. So whether it's a GP or an LP, or whether different types of LPs, fair value. So fair value is reported differently using different methodologies, different inputs. And so that leads to situations where you have the same asset being invested via different funds, for example, with different NAVs at the same time, which is a bit bizarre. Clearly, it doesn't match the definition of having one fair value at one point. The risk-free rates are usually a blend of short-term rates. So there's not much of a yield curve, as I was describing, that's being used. So that tends to create a lot of smoothing of the NAVs and therefore of the returns. And we've also heard some valuers tell us that when the discount rate had to increase, they extended the life of the asset so that the NAV wouldn't change. I'm not sure about this one. I mean, that sounds a bit dodgy to me. Generally speaking to all the key names that do asset valuation and infrastructure, there's a tendency to avoid updating the discount rates and to keep them on the low side. That won't surprise anybody, right? And clearly these practices could be improved, at least some of them, especially number 6. But as I was saying, this is also a data issue. The main reason why people do this is because they can only do so much with the data that they have. They only have few comparable transactions. Maybe it's not that easy for them to come up with yield curves because that requires lots of data and a bit of financial modeling, et cetera, et cetera, et cetera. So it's not that easy to do. In particular, to look at recent transactions, it's not something that is going to give you a lot of good quality data, right? So we know that recent transactions are never enough to provide a granular and robust data set because there are few infrastructure companies that trade. They're all quite different. And so it's not something that is ever going to be very easy to aggregate. And from pure observations, pure deals, this is something we covered in our last webinar on comparables. And so in the end, you always end up observing a biased sample of transactions. And so it's difficult to imagine if you had to value, for instance, an asset that's distressed, which comparables are you going to go to if you're looking at recent transactions? Presumably recent transactions are all good deals, otherwise they wouldn't take place, at least they're viable ones. So they're not already distressed. And so comparables that allow you to look at the price of risk, for example, for an asset that's in trouble, I'm not sure you're going to find this in recent transactions. Another thing is that these things change. Recently, we've had big swings in interest rates, for example. And so even transactions that are 6 months old or 12 months old may not be relevant at all when it comes to comparables. Right. So it's not easy to do, and there's lots of issues with getting the right data. And some of you might think, if you're having a conversation with a friend, well, at least we can observe the NAVs that are reported by the managers, right? That's some data, that's some observations. But no, because what are these NAVs reported by managers? They're just the products of models. We just said that. They're all based on assumptions, CAPM, recent transactions, all of which are require making lots of assumptions. So it's either an explicit model or an implicit model, but in any case, there's always a model somewhere. Until you sell the asset and you know the price that you can sell it for. All infrastructure as fair value estimations are modeled. So it's level 3. And that's why it matters so much to implement these norms properly, or as much as you can. So the real question here is not, can you observe some data because they're reported data from asset managers? That's not the real question, because again, these are just models, the result of models. The only question is, what's the quality of the model? What's the quality of the data? And is it a transparent model? And I think it's pretty clear that it's not the case in most cases. Luckily, if we look at this from academic standpoint, which is what we've done, there's some hope. So just to say that again, recent transactions are never granular enough, and they're not robust. There's not enough of them. So looking for a measure of fair value by looking at recent transactions is indeed a fool's errand. It cannot work, because I think you would need to observe more deals than more data, more deals than there are deals in the world, right? It's never going to be good enough. You're always going to have a model. Again, the question is, what's the model? And here we have a way to turn the problem around from the lack of granularity and the lack of robustness of observing recent transactions, which is that instead of comparing individual companies, try to find an airport that looks like my airport, or try to find a road that looks like my road, etc. We can try and understand what are the factors, the common factors, the things that these companies all have in common that might explain their price from a financial standpoint. And that will give us a lot more information, because every time we see a deal, we'll see some information about something that all companies have in common. For example, the impact of leverage on the price. So I'll come back to this. But first, one thing that all these investments have in common is interest rates. We're all exposed to interest rates. All assets are exposed to interest rates. And this plays a huge role. So here you see this is our little models of the yield curve over time. We recompute this every month, the yield curve in different countries. And then, as you can see, it changes. So here it's going through time, 2007, 2008, and it goes on like this. We have this, we computed this for the last 20 years every month, and we keep doing it every month. As you can imagine, once you change this yield curve, and you change at each point in time that you the numbers with which you're going to discount your cash flows, it's going to have an impact on the value. And so that's a very important input. When you're looking at, for example, a 20-year project in a specific country, you should be using a 20-year yield curve in that country. So that's one thing that all these assets have in common that we can know, we can compute, and we can apply. And as you'll see, it will help us to get the right value much better than not. So let's look at some examples of other things that these assets all have in common, despite the fact that they're all different. So here you see a bunch of examples of infrastructure deals. One that closed in 2010, one that closed in 2018, one that closed in 2017. One is a road, one is a wind farm, one is a metro project. They're all in different countries. And indeed, they are quite different. Even within their peer group, they are quite different. So for instance, if you look at the M40 deal, the level of leverage is much higher than the average level in the sector, let alone globally at the time. So comparing it to other roads might actually not be that obvious, let alone easy to do, because there might not be very many road deals in 2010. Actually, there were quite a few at the time. But these companies all have these things in common. They all have financial dimensions, if you want, in common. So despite being all very different from each other, and even in different sectors and different countries, they all have certain financial characteristics. And so we can try and see if we can understand how these financial characteristics drive the price, and we're going to call them risk factors, then that's going to help us to measure fair value in the sense that for every deal we see, irrespective of what it is or where it is in the world, we'll learn something about how leverage, size, profitability, etc., drive the price of these assets. And therefore, what is the risk premium? What is the market price of risk that the market can bear at that point in time, which was the second element in that equation, right? That, if you remember, that my discounting equation, it had the terms structure of risk rates plus the risk premium. And so this risk premium should be the expression of how these assets are exposed to certain risk. For example, you can have small companies and less small companies. And so size, we expect, should have a significant impact on the value of a company and therefore on its discount rate. In particular, controlling for everything else. So size should make an asset more liquid, for example, or more complex to run, etc., maybe more difficult to buy as well. And therefore, it should be a little cheaper, which have a slightly higher equity discount rate. Leverage, for example, makes another factor, makes the future dividends of the company more risky. Again, controlling for everything else put aside. If you have more leverage, you're more likely to default, and therefore your dividends are less likely to get paid. So if you have more leverage, the company should be a little cheaper as well, right? The discount rate should be a little higher. There's another aspect of infrastructure development, which is investment. Of course, when you invest CapEx, when you sink CapEx into a project, you face greater risk, you have delay risk, cost overrun risk, etc., all of which put your future dividends at risk. And therefore, companies that have more investment, that are in the stage where they're sinking more CapEx, at the early stage, for example, should be also a little cheaper. They should have a higher discount rate. And there are other effects like this. We see, for example, that when companies are profitable, then they are more likely to pay dividends in the future because they have more cash. And so the risks of your future cash flow should be a little lower. Therefore, your asset should be a bit more expensive and have a lower discount rate. And of course, we have different business models in infrastructure. So whether you have a contracted or a merchant business model should make a difference. If you have a merchant business model, your future cash flows are also a little bit more uncertain, even though their growth might be stronger, but that more risk. So the asset should be a little cheaper, etc., etc. Country risk, of course, is important. Countries where the economic outlook is less certain controlling for everything else would be a bit riskier. So there'll be, so this is something we control with the term spread. So assets should be a little cheaper. You have some sector effects, some technology effects. You also have some trends, you might even say some fashions. And so all of these things, all of these common factors that you have in every deal impact the price, right? So if I go back to my equation of the discount rate, we had the risk-free rate. I showed you that you can get this, and you have to compute it, but you get your term structure. And then the risk premia is going to be a combination of factors, right? These factors you can define in 2 bits. One is how much risk there is in the company. So how much exposure there is, for example, how much leverage, how large it is, or how profitable it is. So we call this beta. And then what's the return of this factor, of this exposure? So in the market at one point in time, if you have some exposure to large assets or leveraged assets or profitable assets, etc., you get a bit of return, a risk premium, which we'll call lambda here, right? So in the end, this risk premium is just a combination of betas and lambdas. It's a combination of exposures to risk factors and the price of risk factors in the market at that point in time. And of course, these things change over time. So that's the approach. That's how you re-estimate what drives the price of risk over time. Every time you see a deal, there's a whole bunch of econometrics behind it. I'm not going to go into this right now. That's not really the point. We have other presentations about the more sort of technical side of things. The point is that that risk premium can be estimated over time based on recent deals. And we know what the beta, the exposure, right, is for a whole bunch of assets. So not only can we estimate the risk premium of each factor by looking at recent transactions, we can also apply it to every company that needs to be priced at that point in time, because we know how exposed they are to each one of those risk factors. Okay. So that's quite powerful in the sense that we don't need to find comparable transactions anymore. We need to look at all the transactions and find what they all have in common. They're all comparable. They're comparable in the sense that they all provide information on the price of different risk factors. And these risk factors are found in every company, every infrastructure company. And therefore, they can be used to price every infrastructure company at any point in time. So if I go back to my 3 examples, they're still very unique, okay, and very different in terms of exposure. So again, this company is levered, but it's more levered than the average road, and it's more levered than the average infrastructure. And so when you multiply the betas by the lambdas, when you multiply the exposure by the price of risk, you get different discount rates because every company is different, as we always knew. Right? Everybody gets a different discount rate based on how much exposure they have to each risk factor. But in the end, when you do this, you get an estimated price, which is very close to the actual investment price. In other words, you get very close to what the exit price actually was. And that's because the exit price, the market price, is actually driven by these factors. And so you can anticipate, you can predict the market price, or at least as much as you can, as best as you can, by using the correct yield curve and using the correct estimates of the risk premium. If you think about more generally, how you try to estimate the price, to anticipate the price of, for example, a renewable asset in a market where you know that there's been a lot of demand for renewable assets, you know that the price of risk, the cost of risk, the yield in general has compressed, right? Here, what you see is how much it's compressed because you've understood the components of the risk premium, right? And so these were 3 examples, but you can do this with hundreds of assets and you still find that you get very close to the deal value. In other words, you were estimating fair value by doing this pretty well. Of course, it's not perfect. There's a bid-ask spread. There are reasons why some investors do great deals and get a cheap price, or some investors are willing to pay a lot for an asset because they value it a lot for whatever reason. But it's a market. And this market is driven by these common effects, by these common factors. Everybody's buying and selling infrastructure companies because they're big or because they're levered or because they're profitable, etc., at a certain price. And that's what you see in the data. So if you model this way, you predict the prices very well, which means that you were measuring fair value on an ongoing basis much better. Final thing you need to do this, and this is a bit more specific to what we do, of course, our cash flow forecast. So that's just to give you a point of reference here, that we do cash flow forecasts also in Inframetrics, and Abhishek will come back to this. And they are quite powerful, but that's because I would argue it's because it's infrastructure and it's reasonably easy to forecast cash flows in the case of infrastructure companies, easier than it is for other businesses probably. But most of the time we have the cash flow right, so that also obviously helps us to get the value right. If you don't have the right cash flows, it will be less precise. Of course, the discount rate plays the biggest role, because you're discounting 20, 30 years of cash flows. So the discount rate is the most important effect, but having the right cash flows does help. So in the end, you see that what impacts the net asset value of assets, so this is the average impact on the net asset value of assets through our entire universe, is a combination of the effect of this discount rate, and which itself is made of the risk-free rate and the equity risk premium for infrastructure assets, the individual one that we just looked at, and also the evolution of cash flows. So here you see that, for instance, there's been some growth in cash flows. This is the blue bar, and it says increased the NAVs, but in recent years, of course, in recent months especially, but actually in several years, there's been some serious movements in the yield curve, which has impacted the NAVs negatively, and the risk premium has also increased as well, even though recently it started decreasing again. So you have these effects, and this is what you see in the data. And as I was showing you, this is also what best predicts the exit price, therefore best estimates fair value on an ongoing basis. And one of the proofs that this is actually the case is that if you look at the returns of an index which is built like this, which is the Infrastructure 300, there is no correlation in the returns. There's no smoothing, right? It's just like another financial asset. So it goes to show that you can achieve zero smoothing. So some might find this unsettling because smoothing is part of their pitch. But as I was arguing earlier, if you want to really report things on a fair value basis, you shouldn't be smoothing at all. Luckily, even when you do this, even when you not unsmooth, because that's sort of not necessarily the best methodology, but when you compute things properly and you get no smoothing in your returns, so you get something that's much closer to the real returns, you still get something that's very attractive. So when you mark infrastructure to market, as we do, you find that it has lower risk than stocks or bonds. It has a very powerful diversification profile. It has a good Sharpe ratio, so the ratio of excess return to risk, but one that you can believe, because 0.34, for example, and that's on a 20-year basis, so it's reasonably robust. That's something you can believe, right? When you look at the Sharpe ratio based on the net asset values that are smooth, you get a Sharpe ratio of 4 or 5, which doesn't make any sense. That's not possible. If you into asset pricing, you would have seen that. And so my point is, it's not only possible to do this properly, but you get results that are much more convincing. And as I will argue in a minute, you get results that are much more powerful for investors, because you may have lost the smoothing part of your pitch, but you find that infrastructure can now be used in all sorts of contexts, including, for instance, the ALM, for example, which requires to measure fair value and correlation with other asset classes or strategic asset allocation, etc. But more importantly, it is aligned with the rules. So how might you do this in practice? I'll now let Abhishek show to you how you might do this using the data in Inframetrics. Abhishek.
Thank you, Frederick. And Hello and welcome to everybody from my side as well. So far, Frederick has taught you that the IFRS rules tell you that you have to value the assets properly. There is no such thing as holding to maturity, or I'm in a fund investment or direct investment and so on. The rules are rules. And the second thing that we pointed out in this webinar today was that if you model your fair values properly, you can arrive at reasonably accurate valuations. So with that in mind, in this section, we wanted to show you how Infometrics can help you in your fair value modeling. So in terms of the data availability, we have two types of data that are available in Infometrics. One is at the segment level. So if you are concerned about the valuation of all the toll roads in your portfolio, all the wind farms and so on, and this data can help you understand the right level of discount rate, right level of cash flow metrics, etc. And we will show you in this section. And the second data is actually at the asset level. So if you are more focused on deal making, on exit valuation, and so on, so you may want to consider this asset level data, which can help you, understand the asset level valuations and how they evolve over time. And both of these approaches are still based on the IFRS principles, all the other methodology principles that we explained in the above section. Using these data analytics, it is in fact possible to build some kind of discount rate estimates, some cash flow forecasts that are robust, that are updated every month, every quarter, and they reflect whatever is happening out there in the market, be it macroeconomic environment, be it the equity risk premium change, and so on. So we look at the observed transactions, we look at all the macroeconomic data that's out there, and that's reflected in these estimates. So in this section, I want you to take two examples. The first is about the segment level estimate, like I mentioned. So we'll show you that if you have a portfolio of toll roads in this example, how you can get an estimated discount rate, some cash flow metrics that can help you value these toll roads, the segment of toll roads, and how you can arrive at an IRR at a discount rate that is comparable to the actual deal IRRs. And the second example, it's more of an asset level assessment. We'll show you how you can get to a fair value discount rate by using some more risk characteristics, the common risk characteristics, size, leverage, etc., which are common across all infrastructure assets. And you can use them to find your comparable set. So we'll look at each of these examples in more detail. So in the first one, the segment level assessment, here I have a portfolio of 5 toll roads in Europe that were invested. All of them were invested in the same year. As you can see, in terms of the characteristics, here we have business risk, industry, corporate structure. They are a bit different. So they're obviously in different countries as well, but also by business risk. Some are contracted, merchant regulated, corporate structure as well. One of them is a corporate. And then if you see that how we have mapped it to Infometrics segment, that's the data that we show on an aggregated basis in the Infometrics platform. So we can try to go as granular as possible. So in this case, it would be some companies are mapped against European contracted project finance roads, and that's quite granular. Otherwise, if there's limited data, then you can map it to something more broader, like the Italian road is mapped against a global road segment. And with that in mind, you can now try to look at the comparables in Infometrics. You can try to understand the characteristics of each of those segments, or like we do in this example, you can think of this as a one big portfolio. So next is about the risk exposure. So we talked about size, leverage, profitability. Each of these assets are quite different. They have different size ranging from 500 million to almost 2 billion. Leverage also is quite varied, 57 to 95% and so on. And consequently, the deal IRR that is implied from the transaction ranges from 5% to 11%. So a very broad range because of all these risk factor exposures. But like I say, in Infometrics, you can look at all this data. Global roads is shown here, and you can understand the characteristics of the data and so on. You can try to compare these risk exposures. What is the leverage of global roads? What is the leverage of European merchant roads? And then compare against this individual assets. But also, when you pull up all these statistics for these 3 segments here, I have European merchant roads, contracted road projects, and global roads. And you can compare that as a benchmark. So the average of these three segments becomes your benchmark that you want to compare the portfolio against. This leads to a very productive analysis. So, but it requires, first is that you need to have a representative sample, a broad representative sample. So in terms of global roads, we have about 115 assets. In European contracted project finance road segment, we have 49 assets. And among European merchant roads, we have 28 assets. So all of these three segments are quite broad in general, and they have sufficiently diverse characteristics. Here we are showing you an average between these segments. Second point is that at the portfolio level, so we had 5 toll roads, but at the portfolio level, those nuances of leverage, size, variations, and so on, they tend to offset each other. As a result, the final IRR at the portfolio level, the average IRR is going to be quite reasonable because the range from 5 to 11% gets offset to some extent. And then using an analysis like this, where you have your benchmark properly represented by comparable segments, by appropriate types of business risk, corporate structure, and so on, you can arrive at an estimated discount rate or equity risk premium, which is not too far from the portfolio if you consider that. And that's because at the portfolio level or the segment level, these individual idiosyncrasies of assets tend to offset each other. So now you can look at this for comparison for the whole portfolio, how your discount rates of the portfolio compare, how your equity risk premium of the portfolio changes over time, and you can use this benchmark for your valuation purposes. But this was about the discount rates. The second element that we need is obviously the cash flow forecast as well. And in Inframetrics, we produce a lot of financial metrics. Here I'm showing you two, the average revenue growth and the dividend ratio by the age of the companies. Again, we have the same three segments: global roads, European contracted road projects, and European merchant roads. And in terms of observations, you can see that it's a very broad, rich data set. And here I've created buckets of age, so 0 to 10, 10 to 20, 20 plus. The first thing that you want to do is map the assets to each of these segments to understand the characteristics of that segment, how the pattern of revenue growth is in the contracted road projects, and so on. The second is, you will note that because it's a large database of 1,800 observations in the global road segment, it will lead to a robust estimate of historical revenue growth. So if you want to compare against how these the road projects have grown over time by their age pattern, you can understand this pattern very clearly through this historical data. And third is, in terms of the actual implication of the data, we have found that as infrastructure companies mature, their revenue growth slows down, but their ability to pay out dividends increases. And that's a finding that we could get because of this rich data set, but it differs. The level of growth is different from different business risks, different from business types, and also their dividend paying ability. So all these patterns can be observed very clearly in Inframetrics data, and then you can use it to estimate your own cash flow forecast as an input to your cash flow forecast model. So just to sum up, in this use case one, we learned that assets are exposed to the common risk factors. Here we have taken the example of roads. So all roads tend to have similar exposures to the risk factors. And then once they are averaged out, they converge towards a benchmark that is very well represented, that is made up of the same types of business risk exposures, corporate governance structure, etc. And then if you use a benchmark like that, you can arrive at a fair value discount rate as that is observed in the transactions. Likewise, you can also think about the cash flow forecast. So obviously you need some kind of input assumptions to make a cash flow forecast. And if you use a benchmark that is representative, you can find those inputs that help you build a cash flow forecast model. And using these models, it's possible to have a more frequent, more robust fair valuation, and even for the assets that do not trade. So that's the key part, that we know that these assets don't trade every month, every quarter, but you can get to a fair value estimate that will lead to a very thorough and very robust risk analysis over time. Now, second case was about the asset level valuation. Let's say you are not focused on the segment as a whole, but for deal making purposes or for exit valuations, you want to compare or assess the valuation of individual assets. Now, this problem is a bit like comps problem, finding best comps, the problem that we addressed in our last webinar. You don't have that many recent transactions, and Frederick has already made this point. Just by going after the recent transition is not going to get you to a discount rate that you can just plug in. It doesn't exist. Say we want to value a single road investment, we do not know its fair value discount rate. We have no idea unless we have observed a transaction. So in this use case, in this demonstration, I'm going to take two examples of assets where we have observed the actual transaction. So we know the implied deal IRR, and we will use that to frame the argument. But the main problem is that even if you try to go granular, let's say global toll roads, then you add another filter of European toll roads, and then you want to look at project finance roads in the same year, you're left with a very small sample, which can be quite noisy, which can be not robust. You have very few assets in that granular segment. So what you want to do is instead think about those risk factors, that the toll road that you are interested in has some sort of size, leverage, and so on. So why not leverage on those factors and get to a comparable set of companies that are represented by those risk factors? So essentially, that's what we do in this use case. We observe these common characteristics across assets. We have a large sample. I showed you 115 toll roads in this case. So we can slice and dice it by different buckets here. So roads in the same size, roads with same maturity, contracted roads, and so on. So you can create as many segments as you want. And then you can take the average of each segment as your estimate of discount rate. In practice, how does it look like? Say we are focused on estimating the discount rate within the road sector. We have 4 buckets here: size, profit, investment, leverage. These are the same factors that Frederick talked about in the previous section. So now we can break down each of these factors into these buckets of small size, mid, small, medium size, and so on. So each of these factors has been broken down into 5 buckets. And now what you do is you map your asset that you are interested in for valuation into these buckets, where it's a mid, small size asset, what sort of profitability it has, what sort of capex it has, etc. And what you will get is an estimate of average IRR through each of these buckets, and you can use it to average out the estimated discount rate for that asset. And this method actually is quite robust because each of these has enough number of observations. We have over 250 observations in each of those buckets. So you are looking at a very robust data set. You're looking at the risk exposures that correspond to that asset. So the final estimate of discount rate is also based on those risk factors that the asset corresponds to. You can do the same thing with WACC. So that's another way of valuing the asset. If you want to value the asset as a whole, not just the equity component of the asset, you can build a similar approach. We have WACC data in Inframetrics, and it will allow you to get to an estimated forward-looking WACC for the asset, which can be used to discount the cash flows back and find an EV of the asset, for example. In practice, we have taken 2 toll roads here. The deal IRR is implied from the observed transaction, and we have estimated the discount rate and a WACC based on this approach that I just explained. The first thing is that using these risk factor comps, we can estimate the discount rate of individual assets that I just talked about. So create the buckets of risk factors, take the average of those risk factors, and you arrive at an estimated discount rate. We call that the base case of the discount rate estimation, and they're quite close to the actual deal IRR. They're of course far off, but they're still reasonably close. So they can be used for a fair value estimate. The second thing is that we are not just producing one number, but we are producing a range here, because obviously if you're looking in a size bucket, you have a range of lower quartile, median, and top quartile. So you can estimate a low case, base case, high case, which will allow you to form a more pessimistic or an optimistic view of the deal, depending on how aggressive you want to go on the valuation. So that's another benefit of an approach like this, that you get a range of discount rate that can be used for valuation purposes. So in this use case, what we learned is that because risk factors and yield curve explain the level of market price, if you use the factor exposures, you follow the IFRS principles to the dot, you follow the good practices, and you arrive at an exit value, which can be quite close because of the estimated discount rate. This approach is completely in line with IFRS 13 because it uses all the observed market data that's available at the time. It's frequently updated as and when market evolves. And finally, if the deal is observed, we can do some tests like this and find that the observed or implied deal IRR is quite close to these estimates. So those were the two main use cases I wanted to show. And with that, I hand over to Frederick, who is going to talk about some of the recent evolutions in the fair value landscape and then leave you with some key takeaways.
Thank you. Thank you, Abhishek. Yeah, so we only have a few minutes left. So let me just walk you through a few key ideas here. First, these questions are now at the top of the mind of many regulators. We have actually ourselves worked quite a lot in Denmark with the regulator and with some pension funds that are concerned that investors in DC products, investors who can switch, right, who can trade, which now include a whole lot of private assets and a whole lot of infrastructure, may be trading on the basis of valuations that are unfair. And this is something that is also a great concern for the Australian regulator for the same reason, because DC funds are quite prevalent in Australia. We have a new structure now in the UK, long-term investment fund, which requires monthly valuations for the same reason, because this is something that is related to DC plans. And more generally, in terms of prudential regulation as well, whether it's the PRIIPs regulation or Solvency II, you have to have data that is that's measuring risk. Otherwise, you can't come up with the numbers that will either give you the correct regulatory treatment or the correct risk score if you're looking at retail products. In fact, everywhere, the implementation of IFRS fair value is becoming a concern, given current practices, but also given the size of private assets in general in portfolios, right? And again, this isn't just a constraint. It's not just something that you have to do because the regulator is concerned or these are the rules or whatever. It's actually extremely useful for investors to know the fair value of these assets. Granted, it may be less smooth, but it will allow investors to integrate infrastructure in the portfolio. The denominator effect, which has been plaguing people recently, has a lot less of a problem if you mark to market, right? Because your infrastructure or your private asset position will not be so big and problematic if you mark down when interest rates go up, which is what happened last year. And it's not necessarily a bad thing, right? And having fair value estimates, of course, is extremely useful when it comes to investment, because if you enter at the right price, you enter at the right yield. And after all, that's what you're after. So anything to do with strategic asset allocation, ALM risk management, and investment selection benefits from a good understanding, a well-documented understanding of fair value. So it's really not just a constraint or something that is just for the regulator. It's quite the opposite. So to recap, fair value means the latest market inputs, right, on a given date. It's very simple, and it actually can be implemented when you do level 3. So you have a model, and you always have a model. This is important to remember. There's no such thing as a non-modeled infrastructure value assessment unless you sell it. You still have to hold up this standard. Holding to maturity does not exist in IFRS, so stop talking about it like that. Or at least, I mean, it could be a strategy. Of course, it is a strategy for many, but it's not something that justifies changing the inputs of the valuation approach. And there's a transparency issue today, since everything is based on a model, which is also a problem in terms of IFRS, because IFRS also requires in terms of disclosure, for example, that a number of things. And again, this is also evolving. Again, I'm going to take my cue from the Australians here, but it's evolving everywhere, that more and more of the valuation inputs of private assets have to be published and communicated in a transparent manner. So thanks to Infometrics, you can do a whole bunch of things like that. It is transparent. Someone was asking about papers. The papers are there. The methodology is there. All the data is there. The methodology is based actually on financial theory. So that's something you can also refer to. Just like IFRS, actually. IFRS and what we do is based on the same thing, which is the notion of arbitrage pricing, meaning that there is a market, investors buy and sell assets for a reason, or for reasons, which are these risk factors. And that explains most of the price, right? That's just how you understand fair value. And hopefully this is something that can be of help, of use to you. So I've now run out of time. So I'll thank you for listening, and we will be back with another webinar implementing this in a different context next month on the choice of benchmark for a fund or a yield targeting strategy. Thank you.